Hi there, welcome back to Kila Kitu Bima. If you are new here, my name is Eli Umaya, and in this channel we talk about everything insurance. Today we'll be talking about 3 types of out-of-pocket expenses that we pay despite having paid insurance premiums. We're also going to see the reason behind us paying this out-of-pocket expenses. The 3 types of payments are deductibles, co-insurance, and co-payments, or sometimes what is referred to as co-pay. So these 3 types of payments or out-of-pocket expenses could be in any of your policies. So for example, your auto insurance policy, your homeowners insurance, or even the medical insurance. First, let's start by talking about the deductible. So the deductible is an amount that you pay before coverage kicks in, or that is before your insurance company starts making any payments towards your claim. So let's say you have a $5,000 claim and your deductible is $1,000. So what happens is that you, as the insured, you're expected to pay $1,000 first before now your insurance comes in and caters for the remainder, which is $4,000. So the next kind of out-of-pocket expense that you make is the co-insurance. And the co-insurance is a percentage that you pay after you've already met your deductible. For example, 80-20 or 70-30 or 60-40. So depending with the type of policy that you have, that will be stipulated in it. Just taking from the example of the deductible that I gave, you have a $5,000 claim and you've already paid your $1,000 deductible, and now after paying the deductible there is a co-insurance, and the co-insurance is going to be, let's say for example it's 80-20 in this scenario. So you as the insured, you're required to pay 20% of now the remainder, which is $4,000, and that will be $800. So in total you will end up paying $1,800 and the insurance will pay the remainder. We're going to talk about now the last type of expense or out-of-pocket expense that you may be required to pay, and that is the co-pay or the co-payment. And this is usually a predetermined amount that you may be required to pay before you receive a service. So let's say for example, before you see a doctor or before you get a prescription, you're required to pay a particular amount of money. Now that we've looked into the 3 types of out-of-pocket expenses that you're likely to incur when you file a claim, we're going to look into the reasons as to why we cost share these amounts with the insurance company. And 2 reasons: moral hazard and financial stability. And moral hazard lies in the risk when a policyholder may not act in good faith. So by this I mean you may just decide to be reckless or careless or fraudulent sometimes just to get extra cash from the insurance company, which you shouldn't do at all. But by having some skin in the game, and that is by the cost sharing, you are likely to mitigate whatever catastrophic event that may happen, and only go to the insurance with clean hands and with genuine claims and say that, look, yeah, this is what has happened, and follow the due process. The other reason is financial stability. So insurance companies need to be in good financial health so that they may be able to pay your claims, and by ensuring that they cost share, then they're taking away some kind of financial risk or financial burden from themselves and spreading this equitably so that they may be able to pay your claim when it falls due. Now that we know about the 3 types of out-of-pocket expenses that we're likely to incur when we file a claim, and the reasons as to why we cost share with the insurance company, let me know in the comments section if now it makes sense as to why we cost share with the insurance companies.